We are going to discuss another consolidation question in our tutorial number 8, recognition in unrecognized intangible asset and contingent liabilities. It's given the following statement of the financial position was taken from Brook of A Limited and B Limited as at 31st December 2022. And the examiner asked to required to prepare consolidated financial statement as at 31st December 2022. It's given how many adjustments. There are some adjustments. It's like a normal statement of financial position. Yeah, saying A acquired 75% of the equity in B. It means this is a subsidiary. The control is obtained based on in the acquired share portion 75%. More than it is 50 or more than 50%, we assume that control is obtained. There is 75%. It means indirectly it's saying that non-controlling interest is the 25%. The year of the date of acquisition is 1st January 2022, but the reporting date is 31st December 2022. It means 1 year period. Post acquisition period is 1 year, because January 1st to December 31st, it is 1 year. Some questions it can maybe 6 years, mid-year acquisition, something like that. So be careful on that. The dates are very much important when computing the consolidation questions, right? When the asset and liabilities had the following fair values, it's given the non-current assets 48,000, current assets 15,000, non-current liabilities 12,000, and the current liabilities 15,000. So why these things are given in the sense for the fair value of net asset calculation of the date of acquisition, it's given because we want to recognize the fair value net asset acquired at the acquisition date in order to determine or the computation of the goodwill. We compute goodwill based on the SLFRS 3 business combination. In here, we recognize a goodwill or gain or bargain purchase, the investment against what? The fair value of net assets at the acquisition date. In order to determine that the question is given for the fair values, we know that net asset is equal to the total asset minus total liabilities. And extract of the, I'm reading the question. An extract of the income statement for the year ended 31st December is given. PBT, it's 30,000. The taxation is 27,000, and retained profit for the year is 3,000. It means the for the reporting year, 1st January to 31st December 2022, year profit after tax is 3,000. As per the question, the retain B Limited retained earnings 9,000 at the reporting date. But for the year, it's 3,000 in the sense at the date of acquisition, how much of the return earnings are stood? 6,000 of return earnings are stood because 9,000 at the reporting date. For the year, it's mentioned that 3,000. It means 9,000 minus 3,000 is 6,000 post-acquisition. Pre-acquisition retained earning, because at the acquisition date, you have 6,000 worth of retained earnings plus this year retained earnings 3,000. Altogether, you are ended up with 9,000 retained earnings. I think it's clear, right? The fair value, when you compare the date of acquisition net asset against the book value, you may receive later on we can computation part we can discuss. 50% is goes to the land, 30% is inventories, 30% is plant, and the balance 20% is inventories, because the land are not subject to the depreciation as per the LK 16, because it has a unlimited useful life. But the plant should be depreciated. The excess depreciation should be recognized in the consolidated financial statement. For such adjustments, it's given the additional depreciation charge required due to the fair value adjustment is 6,000 per annum. The land fair value acquisition date was sold on 1st October 2022. So you want to adjust those things as well. The B is unrecorded, unrecognized intangible is 9,000, and the contingent liability is 15,000. I'm ignoring the last 3 zeros. On the acquisition date, the group amortized its intangible asset over 5 years. The fair value of the net assets attributable to the non-controlling interest is given at the date of acquisition is 15,000. You are required to prepare consolidated financial statement. These kind of things is basic consolidation. So first of all, you want to prepare the consolidation adjustments, the group structure and date of acquisition. So for that, I will share Excel with you. I think it's visible. As per the question, it's mentioned that 1st January 2022, A acquired B 75%. It means remaining 25% is goes to the NCI or the non-controlling interest, right? Reporting days is 31st December 2022. So there is a 1 year post-acquisition period because the January 1st to December 31st, it's 1 year, right? So we compute the goodwill or a gain or bargain purchase, sometimes referred as a negative goodwill on the date of acquisition. So we compare against investment against fair value of net asset acquired, right? So as per the first adjustments, it's mentioned that I think I want to go to this one, right? A acquired 75%. We know that 25% goes to the MCI. So the acquisition date, it's given the 48,000. The current asset is 15,000 and the non-current liability is 12,000 and the current liability is 15,000. So total asset is 48 plus 15. How much is it? 63 minus 27,000. We are getting 36,000 of net asset at the acquisition date, right? 36,000 of net asset at the acquisition date, asset minus liability. So it's clear. So the net asset fair value as at January 1st, 2022, this is the reporting date. Sorry, not reporting date, acquisition date of acquisition fair value, right? As per the question, it is mentioned that 36,000, but at that date, the book value should be ordinary shares because it's not mentioned that the ordinary shares stated capital is changing over the period. So the B column you need to refer, right? B column, the equity is 18,000. So we recognize that it mentioned that for the year it's 3,000 worth of profit, but as the reporting date, as per the SOFP or the statement of financial position, it mentioned 9,000. It means pre-acquisition retained earning is 9,000 minus 3,000, it is 6,000, right? It's mentioned. You can refer how this 6,000 derived. 9,000 minus 3,000, it is 6,000, right? I think it's clear for you. But general reserves, it not mentioned that general reserves are subject to any change, post-acquisition changes. So you can assume that this is the general reserve balance to that date of acquisition, right? 3,000. So now we compute against net asset fair value against the book value. Book value is 27,000, but there is a fair value reserve is how much? 9,000. 9,000 is derived from 36,000 minus 27,000, right? It is 9,000. I think it's clear. For this 9,000, 50% goes to belongs to land. It's mentioned. Another 30% is plant and remaining is inventories. Right. It means 9,000 into 50% is land. Fair value increasement is 4,500 because 9,000 into 50% in the sense 4,500. Remaining 30% in the sense it is, I think, 2,700. And the inventories, such inventories is 9,000 into 1,800, right? Right. These things are there. Now you want to compute the goodwill on date of acquisition. Date of acquisition, I think it's visible here. So later on we can discuss the goodwill. But in here excess depreciation based on the plant is 6,000 per annum. Sorry, 600,000 per annum. The fair value land date was acquired is sold 1st October 2022. So it's easy because land are not subject to depreciation. Unrecognized intangible is 9,000. It should need to be recognized. And the contingent liability is 15,000. It need to be recognized. The amortization is 5 years and non-controlling is given. So now we can go ahead with the computation part. Like for the cost of control account, I'm going to discuss this. Investment is mentioned that 51,000 I will derive. The investment is in the statement of financial position is 51,000 is there. A. Because A is the parent in this case, B is the subsidiary, right? The 51,000 investment should be recognized. The NCI double entry is what? NCI credit because it like a liability account. It's a part of liability, like a liability because the increase of the liability because we are not owning non-controlling interest. It's like a liability. 15,000 the cost of control debit and the NCI credit, right? The cost of control 15,000 at the acquisition date. Later on discuss these contingent liability. The time being, let's forget about it. The ordinary shares we discuss 18,000 at the date of acquisition. In here we recognize the date of acquisition. Retainer is 6,000, reserve is 3,000, right? Right. These things we recognized. No, ordinary shares, it's recognized. The retained earnings, it's recognized. Right, those things. And the general reserve also we need to be recognized 3,000, right? The intangible asset, unrecognized intangible asset, the double entry is cost of control account credit, and the intangible asset is debiting. We are debiting intangible asset 9,000 here, right? That's why. And the inventory 1,800. We discussed that the inventory is 1,800. Double entry is inventory credit, it's asset, and the cost of control should be credit because net asset is increasing when the asset is increased, right? The land also like that 4,500, and the plant also like that. Based on tally this balancing, we have a contingent liability. If it is liability arise, it means liability is increasing. It implies that net asset is decreasing because asset minus liability. Let's assume asset is 100, liability is 25, the net asset is 75. In the time being, let's assume the now after recognition such intangible liabilities, now the asset is 100, and the previously we have 25 worth of current total liabilities. Now it is 25 plus 50 no 15 to it means the need to be deduct because 25 minus 15 that means 60. Now it means such liabilities arise, it impact for the net asset. The net asset will be decreased. So in order to show that impact, we debiting contingent liabilities to the cost of control because it's reducing due to this arisement of the contingent liability. It decrease the net asset in order to emphasize, in order to show that we debiting to the cost of control account and crediting to the contingent liabilities. New liability should be recognized, right? In here, the statement of financial position, we recognize such liability as a contingent liability, right? So based on that, when you are telling these things, you will ended up with a goodwill on 36,000 goodwill debit and cost of control credit. The goodwill is 36,000. It's clear, right? I think it's clear that adjustment. Now later on, you want to compute we fill up with these 15,000 NCI. The consolidated retainings balance brought forward balance is 42,000. 42 here you can see the retained earnings group is 42,000, but subsidiary is 9,000. You want to show those things. Subsidiary retained earnings, these retained earnings, it's 9,000. I'm going fast because this is a revision. 9,000 subsidiary. The general reserves group consolidated general reserves 15,000 at the opening balance, and the subsidiary B's general reserve is 3,000 as per the question, right? So we debiting it to the we crediting it to the cost of control and debiting it to the general reserve. There is a zero balance because at the acquisition date also 3,000. We transfer it to cost of control account in order to compute the goodwill. That's why this is here. This is tally. No such impact is there, right? Now the thing is we discussed these adjustments and the excess depreciation due to the plant increasement fair value 600,000. You want to think about who now own this plant. Subsidiary own this plant. So the double entry is depreciation. The asset should be reduced by 600,000. In order to show that we debiting it, we crediting the PP by 600. This is thousands. 600 and crediting into where? Who owns this inventory? Sorry, his plant. Subsidiary owns this plant. So in order to show that, we debiting it to the subsidiary return earnings. That is simple, right? Subsidiary return earning on excess depreciation is 600,000. 600, right? So the intangible asset, we recognize the 9,000 worth of intangibles. Debit intangible asset, credit to the where cost of control account. We previously do that, right? After that, we want to amortize over the period. The amortization is 5 years. It means 9,000 divided by 5 is 1,800, like that. Because intangible asset should be credit because it's like an asset, credit. And the debiting to the where, who owned that intangible asset? The subsidiary owned that intangible asset. You want to debiting it to the subsidiary return earnings, right? Not for the consolidated, right? This is easy. Right. Right. The next one is the fair value of the land sold 1st October 2022. It means the 4,500 increase of the land we sold. It means land credit debit to where the the subsidiary return earning. Why I'm saying that? I think it's clear land debit credit because it's asset. You want to credit to the land. I think it's clear, but most of the people don't know why it's crediting to the debiting it to the subsidiary return earnings. Because land it's clear 4,500 land, but let's focus on this. Like, let's assume subsidiary perspective, the selling price is 50,000, group also that, but subsidiary costing is 40,000, but group perspective it is fair value. The date of acquisition we value up it's by 4,500, 40,000 plus 4,500 is 44,500. So group recognize 5,500 profit after deducting sales price minus cost, but in the subsidiary it's recognized 50,000 minus 40,000 at the reporting date, right? It is 10,000, but the group perspective it is 5,500 because it's group recognized it's lower profit. There is a excess profit or overstated profit in the subsidiary return earnings is how much? 4,500. So in order to impact that subsidiary return earnings, we are debiting because in order to show that overstated profit, right? We are debiting it to the subsidiary return earnings. Subsidiary return earnings, land sold. For the another adjustment is we assume that the land, the inventory also sold. The fair value increase inventory also sold because it is 1 year after the date of acquisition. The inventory also should be derecognized by 1,800. The inventory is credit. Who own that inventory? Subsidiary own. It also like a land. We recognize overstated by the subsidiary return earnings like a land. This adjustment. So we want to eliminate it from subsidiary return earnings. We debiting it to the subsidiary return earnings, right? We debiting it to the subsidiary return earnings. Where is that? I can't recognize at once. This there. After balancing this, the whole things is now over. After balancing this, we ended up with the subsidiary return earnings. A negative return earnings. It means a loss. The loss should be distributed among the parent and NCI. It's when we are telling these two, to the time permits, I'm using this. Right. This is this much. I'm using this, and the remaining for based on that consolidated return earnings 47%. The remaining should be goes to where? No, I'm wrong because this minus this 5,700. 5,700, 25% is on to the NCI. Such loss should be distributed among NCI. The remaining should be distributed among parents, 75%, right? The double entries, NCI portion, right? NCI portion, NCI should be debited because with the liabilities decreased due to a loss and the retained earnings credited. The consolidated retained earnings debited and the subsidiary retained earnings credited. We using those impact in order to show this impact, right? NCI also it's debited like this. NCI 1425, 1425. Where is that? Yes, this is the there. And next, the consolidated retained earnings should be debited because we need to show that impact, right? Which is there, right? Now it's over. So now we want to line by line addition. It's easy, right? Now it's become seems like easy. Right. Now it's clear. Investment, it's 13,500 because these investment are this parent, the remaining investment. That's these two 42,000, 6,000, 16,500. Line by line addition. Later on, you can end up with this. Now adjustment is over, right? Equity attributable parent investees, equity holders, parent, ordinary shares, general reserve, and retained earnings. So retained earnings you can balance no. Balance carried down. It's clear, right? It's easy. The computation part, the goodwill and the subsidiary return and distribution among these NCI and console, it's little bit complex. Other things is okay. It's basic, right? Those things should be need to be bothered about in like this kind of a question. Others are okay. Then you will ended up with 1,171,300 total assets. And the equity also, equity and liability should be tallied because the basic accounting equation is plus asset equal equity plus liabilities, right? That's okay. That's the end of this question. Thank you.